Good afternoon and welcome to the second in our series of webinars on the Fife Pension Fund proposals from April this year. I'm David Davison. I'm going to be your presenter today. I'm one of the owners of Spence Partners. We're a firm of consulting actuaries and pension consultants. I head a charity not-for-profit practice within the organisation, and I've been running that probably for about 15-16 years, so advise sort of many hundreds of third sector organisations in local government schemes and other multi-employer schemes, and work with a lot in Scotland. I've worked with the SPPA, Scottish Public Pension Agency, on sort of regulation changes back in 2018 to local government schemes, and I'm currently working with them on sort of further revisions. And I've worked with sort of ICAS, Charity Finance Group, and PLSA, and sort of lobbying for charities in particularly in local government schemes as well as in other multi-employer schemes. I've also already worked with charities in the Fife Pension Fund, so I'm very familiar with the offer, and I'm well advanced with some of those employers in terms of understanding what the process actually is and what you need to prepare yourself for if you're reviewing. So obviously, I'm hoping to be able to give you sort of an independent view in terms of what the offer means and what you should be looking at. So what I'm going to cover today is basically just to start off by outlining what the LGPS risks and issues actually are. So what you need to be considering as part of any review. Look at the Fife Pension Fund proposals in a bit more detail, consider the options and next steps. You'll notice in your screen on the top right hand corner there's a little question mark. So if you've any questions, if you press that, I'll pick up the questions at the end of the session. So I'm expecting the session will last around 3/4 of an hour, so leave us with sort of plenty of time for questions at the end. Okay, so in terms of any options review, I think that any charity participating in the local government scheme would need to undertake. I sort of tend to break this down into sort of 3 key areas. I think the charity needs to understand, first of all, the affordability. So participation in the local government pension scheme comes at a cost, and you need to understand what that cost is now and how that cost actually may change in the future to make sure the scheme remains affordable. I think you also have to understand the risks entailed. So the local government pension scheme is a defined benefit scheme, so it has an uncertain cost, and the assets and liability values can move in the future, and if there's material movements in those, that can result in additional costs, and you need to understand what those are and how those impact on the charity's finances. And then the third thing is HR implications. So you need to understand how the current pension scheme is perceived by staff and the implications of actually changing that scheme. I'll go through some of those as we go through the session actually today as well, but I think each organisation has a point in the middle of those 3, I think, where they can identify what's actually for the good of the organisation going forward and also for the individual staff members. So in terms of the LGPS pension scheme, which Fife is one, the benefits in the scheme were provided on a final salary basis up until the 31st of March 2015. The benefits are therefore related to the person's salary and service, and I'll show you an example of that in a second. After that, from basically 1st of April 2015, the scheme was provided on a career average revalued earnings basis, where you build up benefits each year based on salary, and I'll show you an example of how that works. The crucial element of these sort of defined benefit schemes is that all the money and all the members are in this consolidated pot, so no one has an individual promise of a certain amount of money sitting in a pot. They have a promise of a benefit that they're going to get at some point in the future. So that means that each member that's in there effectively has a relationship with every other member in there, and every employer in there has a relationship with every other employer. So, and I'll explain the impact of that as we go through. Obviously, the career average revalued earnings basis that it moved to is now the shape of pretty much all public sector pension schemes. The concern with final salary pension schemes was that if salaries moved very materially close to retirement, then there hadn't been enough money paid in to buy those benefits as you went along. Therefore, there was a cross subsidy between other members of the scheme, which the government was trying to avoid. So hence the move to the career average basis. So if I look at examples of how that works in practice, under the final salary scheme, if you started with a salary of £20,000 and you were working for 5 years until retirement, assuming that the salary went up by 3% a year at retirement, the salary would be £23,185. Assuming an accrual rate there, the 60th rate was designed that if you had 40 years service in the final salary scheme, you'd have 2/3 of your final salary when you retired. Obviously, if you've lower amounts of service, then you get a lower amount of proportionate benefit. So with 5 years, it would be 5/60 times the 23,000 at retirement would give you a pension of just over £1,900 a year. Clearly, if your service was twice that amount, then you'd have twice the amount of pension, or 3 times, you'd have 3 times. Or if your salary was higher, then it'd be based on the higher salary. So it's quite a simple calculation with those sort of 3 parameters. The career average, each year's service is treated in isolation. So what happens is in the first year, you'd have for example, in this example, a 60th of the salary in that year. So a 60th of the £20,000 would be £333 of a pension. Now, obviously, if you earned that 5 years ago and you waited until you got it today, then it wouldn't have the same value. So that's where the revalued bit comes in. So it goes up in line with inflation. So you can see there each year that goes up in inflation. So the 333 at retirement is worth just short of 380. The following year, in year 2, if your salary is now going up, you buy a slightly higher amount of pension that year, and it then goes up in line with RPI again each year after that. So you can see from this that if your salary went up in, say, year 4, then it would only affect the year 4 and year 5 pension. So it protects you from this sort of underpayment over the period. So what you do is at the end, you total all those together and you get your pension benefit. And that's just obviously just over £2,000 on that example. And one of the things in terms of the change was obviously this was to try and reduce the overall cost of benefits. But what happened was the accrual rate actually increased after 2015, which actually sort of improved the amount of benefit people were getting year on year by about 20%. And so that potentially increased the cost. So and obviously what's been happening over the last 10 years or so is that on average inflation has been going up probably higher than salary increases, so therefore the care benefit was ultimately probably even providing a better benefit than the previous final salary scheme benefit. So that has impacted on the cost of running the scheme as well. So what you're doing is you're building up a lot of these benefits, which is your liabilities for staff, and obviously the more staff that are in there with the bigger benefits, the bigger those liabilities are. So what you're trying to do is you're then trying to build a set of assets in the scheme that cover those promises, that cover those liabilities. And you do that by making contributions and getting investment return on those assets. If there is a shortfall in terms of paying for those benefits, you've got a deficit. So that deficit has to be funded by the employer. So that's effectively an employer guarantee. Now, any benefits that have been built up to date, you can't go in and actually change those. So the employer is responsible for making sure that any shortfall is met. Now, as you build more benefits, those liabilities increase and the assets increase, and potentially so does your future deficit. So the issue around this is obviously that the greater the liabilities you have, the bigger the risk. So if you have £1 million in liabilities and there's a shortfall of 10%, then the employer guarantee they've got to find is £100,000. If alternatively you've got £10 million of liabilities, then if there's a 10% shortfall, you've now got to find £1 million. So the bigger those liabilities get, the greater the risk is for the charity. So if we're trying to work out what the cost of actually buying those benefits are, then ultimately the benefits are the benefits that are promised to members plus the cost of actually providing them, and there's an inherent cost within the scheme of running the scheme. So the ultimate benefit, your defined benefit, is based on someone's salary. It goes up then in line with inflation, and it's paid for as long as someone lives. Now, what obviously, although you're providing for a defined benefit, what you don't know is what any of those are actually going to be. So you have to make an estimate. So if I take an example then of if I'm providing someone with a pension of £100, a payment of £100 in 12 months' time, then the amount I need to put away today depends on the expected return I'm actually getting on the money. So if I put £95 away today and I get a 5% return, then I've got £100 to pay the individual their pension. If I get a 2% return, I need to pay £98, and if I get a 9% return, I need to pay £92. So you can see immediately that the higher the return you get, the less you need to pay in contributions. The other thing you can see there is that the difference in those returns for over a year are relatively small. So if, for example, you were paying £95 in the expectation of getting a 5% return and you only got 2% return, you'd be £3 short, which the employer would have to make up. If, however, you were doing it over 20 years, then the cost of actually buying the benefit at 5% is much lower at £38. But if you only got 2% return over the period, then you'd actually be £39 short. So that shows you how there's a deficit could actually arise. The other thing that highlights is that the cost of actually buying the benefits increases as you get older. So a year away from retirement, your £100 costs you £95 at 5%, whereas 20 years away it costs you £38, because £62, the balance, would actually be made up of investment return. So that highlights that differential as well. And you can see that in funding with the LGPS as well, because if the cost actually sort of rises as you get older, you'd expect the cost to be higher at 64 than it is at, say, 20 or 21. Then what happens within the scheme is the scheme averages that out across all of the members and comes up with a contribution rate for each employer. So that means that each employer, their staff, if they're younger, they're effectively overpaying for their benefit, while older staff underpay. Now, that approach works fine on the proviso that if you're on the proviso that if staff get to retirement age and they retire, they're replaced by younger staff, which keeps the average age the same. But if that doesn't happen, which is usually the case with most charities, because the scheme has become so expensive that they tend to close it to new entrants, so you'll have a falling number of members actually in there. So what happens now is that the average age actually in there increases, which means you cut the line at a slightly higher point, so your contributions actually increase, and that continues to happen year on year. And even if the scheme was actually open to new entrants, then the problem with that is then you're building up liabilities more and more quickly, which again increases the risk and affordability issues. So there's a bit of a sort of a catch-22 position. But ultimately, charities will be very aware of that because they'll have actually sort of seen that happening with their contributions. In terms of then the funding basis, within defined benefit pension funds or local government pension schemes, there's effectively three key valuation bases that you need to understand. One of them is the FRS 102, so that's your accounting basis. Now, the accounting basis should produce the lowest value of liabilities, but recently it hasn't done because the assumption on the return that I was showing earlier on, the discount rate, that assumes a return of AA, so good quality corporate bonds, which are probably down around the sort of low 2% at the moment. So that puts a relatively high value on the liabilities on that calculation. So that's the figure you'll get that goes in your accounts. The ongoing contribution basis is the basis that the fund uses to actually calculate your contributions, and that will tend to assume an expected return on the assets. So that might be something like about 3.5%, something like that. So at the moment, that will be producing a lower value in all likelihood than the accounting value. And then the third value there is what's called a cessation. So if you're an employer that's actually in this scheme with all these other employers, then if you decide you want to exit the scheme, then that's the only point at which the scheme can actually get additional money from you, and therefore they're going to make sure that they actually get the highest amount of money so that it protects the other employers that are in the scheme. So you wouldn't want to be in a position where other employers left you with a deficit, in the same way the scheme will want to protect other employers if you decide to leave. So the cessation will produce a much higher liability and therefore a much higher deficit than either the accounting or the ongoing funding position. So in terms of the pension fund, the local government scheme, actually looking at each employer, there's effectively 3 bits that you've got to consider whenever you're actually looking at the sort of funding and the risk from that employer. So, and the starting point effectively is really the point I put at the bottom there, the covenant. So the strength or the financial strength of the organisation. So if you've got an organisation that's got £10 million of assets and £1 million of pension liabilities, then that's a very strong covenant. Therefore, the pension scheme can invest quite aggressively in terms of getting return, because it knows that even if that investment return isn't successful, the charity can actually afford to cover that and pay higher contributions at a later date if necessary. So by getting the higher return, your contributions reduce. If, however, you'd £1 million of assets and £10 million of pension liabilities, then your covenant is relatively weak. The fund then is looking at you sort of saying, well, if this goes wrong, we can't afford to get the extra contributions. Therefore, we have to invest more conservatively. Therefore, if you invest more conservatively, the contributions are effectively higher. So how the scheme is looking to set the contributions is based on the strength of that employer covenant. And again, with charities, funds have been looking more and more closely at that over the last number of years. And funds will actually be increasingly concerned about that, because obviously if the employer can't pay what's actually due, then the concern is that that affects other employers that are actually in the scheme. So funds are starting to look at this quite carefully as well. So ultimately, in terms of the scheme, then the member has a sort of salary related benefit, so that provides certainty in terms of their pension benefits. Their benefits in the scheme are protected by all the other participants that are actually in the scheme. So even your staff will be protected by the council effectively. So almost regardless of what happens to you, the members will actually be protected in terms of getting their benefits, which is good news for member security. The members also pay a fixed percentage of their salary based on their salary, so it increases as their salary increases, and that could increase in the future, but there's no sort of requirement to do that at the moment. But the employer's contribution rate is different. It's assessed every 3 years by the actuary of the scheme to work out how much needs to be paid. And it will then set a contribution rate so that you can build up the assets to pay the benefits when they're due. So that's based on your contributions and the investment return. The objective within that funding is to try and get the employer to pay the costs within the employee's working lifetime, so that there's no legacy in terms of actually funding after the employer's left service or retired. And as I said, as members accrue benefits, the liabilities increase and therefore the risk increases. So from a charity perspective, there's a wholly uncertain cost in terms of providing these benefits. The scheme is usually funded on the basis that the scheme continues, but obviously if you're close to new entrant, you know that at some point that you're not going to be able to participate in the scheme indefinitely. Therefore, your contributions are likely to rise as a result. As I said, there's a much higher liability for charities on exit or closure. There's a much higher level of focus from the schemes on the employer's covenant, so their financial strength to make sure they can afford to be in the scheme. As employees live longer, then that increases the cost, and as closer to new entrants increases the contribution and cost as well, because you've then got an aging membership, so the cost of buying those benefits as members get older is higher. And as I also said, you've got this cross-generational subsidy between younger and older employees, reflected in the ultimate cost of those contributions. The cessation point is that ultimately, if you have members who are actively participating in the scheme, then that's fine. But as soon as you cease having any active participants who are paying into the fund, then that effectively triggers a cessation. And the process is actually outlined in the Local Government Scotland regulations. So the fund actuary would do a calculation that will determine what your cessation debt is from the fund. It would be based on market conditions as at the date of exit, and because that's calculated at a date, so that could be calculated, for example, today, you wouldn't get it for 2 months, so you won't know what the figure is, and by the time you come to actually pay it, you'll know what the figure was 2 months ago, but you'll not know what the figure is at that particular point in time. So there's an element of uncertainty in terms of the market conditions, in terms of getting out of the scheme. The fund will robustly pursue that debt from each employer, as they view any underpayment as money falling on other fund employers and ultimately the members. And as I said, if you're closed to new entrants, ultimately your cessation debt is inevitable, because you're going to run out of active participants and therefore be exiting the scheme anyway. A couple of other things to be aware of, obviously, are also what are called pension strain costs. So if an employee is removed on the grounds of what's called operational efficiency in the rules, but effectively just means redundancy, then there's an enhanced early pension payable. That enhanced early pension has a cost, and that cost is passed on to employers. So if you've got staff over 55, the amount, this could be due and the amount could be material. So actually it's just something to be very aware of in terms of not making staff redundant in the local government scheme unless you know, and I've spoken to the fund about what the cost might be. The other thing is that your financial position now is very visible, because it'll be produced in your accounts under FRS 102. So people will be able to see the amount of the liability, and that can have an impact in terms of funding and sort of future security. As I said earlier, the discount rate's based on AA corporate bonds, and those are relatively low, which puts a high value on the accounting liabilities at the moment. And those liabilities are likely to be greater than the ongoing funding position, although less than the cessation funding position. Okay, so in terms of the specifics of the Fife Pension Fund and the offer, Fife Pension Fund's a local government pension scheme. It's one of 11 funds in Scotland. Charities participate in the scheme as admission bodies, based on an admission agreement, which will be signed at the point that you actually join the scheme. If you were joining now, it's highly unlikely that most charities would be allowed to join, because they would actually need a guarantor, such as the council, to actually stand over their liabilities. This wasn't the case historically. Organisations with a public interest were allowed to join any of the authorities they were working with. Obviously, if they, in terms of individual charities, should check that they haven't got any historic guarantees with the council, would actually allow them to continue to participate without having those sort of that cessation risk, for example, in the future. So that's something that's worth looking at. So why would Fife Pension Fund then look at making proposals to charities? Well, they've become increasingly concerned by the employer covenant of charities participating in the scheme. So they're concerned that if charities were to have to pay a cessation debt, they wouldn't be able to afford to do so. So there's therefore a concern that the more and more benefits they build up, the greater the risk that's passing on to other employers actually in the scheme. And by other employers in the scheme, that's predominantly the council, because they probably have about 90+% of the liability, so they'd end up picking up the costs of building up more liabilities. As the pension costs increase as well, this increases the risk of charity insolvencies, which would disrupt local services as well as leaving the pension debt. So the council's trying to avoid that as well. They were looking for an effective and consistent way to manage these risks. And I know certainly a couple of the charities I work with had approached Fife Pension Fund looking for solutions, and this came out as a result. So the fund actually then the council put proposals to the Fife Council Policy and Coordination Committee, and these were actually agreed in principle back in January 2020. There was supposed to be some other sort of steps, but with COVID and so on, some of the meetings were delayed. But ultimately, the letters were actually issued to the affected employers late in April this year. effectively what has happened is that Fife Council has agreed to take on all future liabilities for each of the charities, subject to the terms actually set out in the letter that was issued to the charities. So that means that any charity can exit the fund based on the ongoing funding position, so effectively the best funding position I was showing there, and also based on the funding position as at 30th of September 2019. So there's certainty around the figures. That means that the figures that you would be exiting on would be much improved over either the cessation or accounting position at 30th September 2019, or indeed the current position, because the current position would be taking into account market conditions post-COVID, where obviously asset values will have fallen and the value of the liabilities is likely to have risen. Therefore, the debt level is likely to be much higher. So the terms of the offer actually said that any charity looking to avail of the offer will have to provide formal notification in writing the Fife Pension Fund by the end of September 2020 at the latest. The ongoing funding basis at the September 2020 will be used, which may result in a payment being due, but obviously that payment would be much lower than would be the case on the cessation basis. The exit from the fund has got to be finalised by the 30th September 2020. There's got to be confirmation in the communication to Fife that the charity has adequately consulted with staff, and any contributions, costs and expenses due prior to 30th of November would actually have to be paid in full. So the information in the letter includes the 2017 valuation position, so showing what the funding position was at that point. It also shows, and this is where there becomes a bit of confusion around sort of terminology potentially. So there's a cessation valuation, what's described as a cessation valuation as at 30th September 2019. But this is effectively on an ongoing basis. So this is on the weakest or the middle position that I showed earlier. There is also then a gilt-based cessation valuation. So that would be if the offer hadn't been made, what you would have been paying in terms of the exit cost at 30th September 2019. So if there's no debt on the cessation valuation, the second one, so the ongoing basis, then the charity can exit the scheme with no payment being due. The gilt-based cessation valuation will effectively show you the saving that's actually being made. So, for example, if the ongoing valuation was nil and the cessation valuation was £400,000, then the exit amount you're saving is £400,000. If the ongoing deficit was £50,000, then effectively you're saving £350,000. If on the ongoing basis there was a surplus, in other words, there were more assets being shown than liabilities, then you're allowed to exit with a nil debt, but there's no exit credit being paid. There's no payment back from the fund. Any change that happens post 30th September 2019 will not impact. So the market condition changes from recently won't have had any impact. So you're working on those figures as at September 2019. There's supposed to be a presentation from the fund and the fund actuary Hymans, although I would just point out the sort of employees obviously that Hymans are advising the fund and therefore would be conflicted in offering employer advice to any of the admitted bodies. So if we're looking at engagement in terms of if you're looking at engagement with staff around the offer, the first thing you'll need to actually identify is what your contracts of employment actually say. So do you actually offer Fife Pension Fund as a formal contract of employment or part of the contract of employment, or does it just say that the staff are offered a suitable pension scheme or the pension scheme of the charity or whatever? The other thing is you have to identify whether you've any staff who participate in the scheme under some sort of protected arrangement, such as fair deal, for example, where you're providing services to the council where members have to have participation in the fund in order to discharge that contract. So that's something you need to check at sort of stage one, because that will add complexity to the consultation process. If you have more than 50 employees then the pension regulator requires you to do a statutory 60-day consultation period. If you have less than 50 employees, then the consultation period is voluntary, though I would expect that given the magnitude of the changes that are actually being proposed, if you were changing from Fife, then you may need to certainly at least a 30-day, maybe 45-day, or potentially 60-day consultation with staff might be necessary. The other thing about the consultation process is that ultimately your objective is to try and have all staff agree to the change of contractual terms. If, however, they choose not to agree to those terms, then the last resort you would look at, and it would effectively be a dismissal and re-engagement process where people have their contracts ended subject to sort of notice and then are re-employed on a new contract without the pension scheme included. But as I say, that's an absolute last resort. You want to try and avoid that. Unfortunately, in consultation exercises so far, I think we've been able to avoid that actually happening. The consultation timing obviously will be driven therefore by the staff numbers, dismissal and re-engagement process as well, and obviously putting in some form of contingency. You need to really work out a realistic project plan to allow for all the factors, because you're going to have engagement obviously with the board, and then engagement with the staff, and then engagement with the fund and so on. So you need to put in enough time to do that. The board obviously also need to consider how far they want to go to replicate staff benefits. I think in terms of the consultation and communication as well, is transparency is key. I think you want to sort of try and make sure that staff are as aware of what's going on actually as possible. And the key bit I would put at the bottom there is that the consultation period ending in 30th September, that will come very quickly. We're sort of in June now, but 60 days, as we're sort of getting into sort of early part of September, by the time you'd actually be starting to communicate with staff. So if you're using a shorter time period, then it gives a bit more time. But certainly, charities looking at this really need to be looking at it very, very, very soon. In terms of the consultation with members, therefore, I think the document that would go out to start that, I think, really should contain this sort of information, background on what the changes are, what the proposal actually is that's being made and why it's being proposed. The difference probably between defined benefit pension schemes and defined contribution schemes, because in all likelihood you'd be wanting to move, if you were moving from the scheme to a defined contribution scheme, which gave you certainty of contribution cost. Then considering how any change will affect each individual actually in the affected group, and then explaining how the consultation process works and the time scales. And then finally, you need to be aware where support's available. Is that support that's actually provided by the charity, or is that sort of generic support that's available by other bodies that staff can talk to? And then also there could be an input required for legal advice as well around the contracts and the sort of communication and so on, and making sure that the documents that confirm exit are all correct. Also, obviously, there's a need to engage with the recognised trade union if there's one, and they would expect a meaningful consultation to actually be carried out with staff. You need to provide member presentations, in my view, to actually make sure that staff understand the rationale and the sort of impact of the change. And also, you might want to consider sort of providing staff with one-to-ones about how the change might actually directly affect them and what options they have going forward. One of the things when doing these exercises we always do is unusually is also provide staff with a comparative illustration that's based on their own personal circumstances. That I think really helps in terms of this sort of process, because it allows staff to actually be able to see the exact impact on them, both in terms of the cost that they're paying and also how it would impact on their benefit. And coming up with a fair comparison between those allows them to sort of plan for future benefits. As I say, we provide this illustration because also there's a perceived impact. There's a perceived impact from the members, that the change is actually, the impact of the change is actually going to be greater than the actual impact. So showing people what the reality is can often be better than what the expectation is. Complete transparency is key, sort of making sure that staff are aware that you're giving them as much information to help them with their decision as possible. Lack of understanding of the existing scheme and how it works, so that the illustration can really highlight how the scheme works and how the benefits will be provided in the future. And as I say, staff want an indication of how the change will specifically affect them. And if you provide some sort of uniform or sample illustrations, that just doesn't do that. So the sort of bespoke illustrations that we provide give that sort of level of understanding and comparison. And as an illustration, this is one we should have done quite recently. So this looks at what the projected salary is at retirement, what benefits are actually built up in each of the different categories in the LGPS, what the state benefits likely to look like, and then ultimately giving you a projected percentage of what your final salary is. And that way, what you can do is you can compare that with your existing salary. So if it's 75% and you're on £30,000 of a salary, then you know that, well, at the moment we're providing a pension that's going to roughly be worth around £22,000 a year. Is that enough, or do we need to plan for something else? Then what we look at is what the contributions might be on the defined contribution scheme going forward. So again, looking at what the projected fund value is like, and this takes into account if you're providing a salary sacrifice arrangement as well, which can improve the value of the benefits at no additional cost. And again, then the member can compare and look at if that's enough of a retirement benefit to actually retire on, or if they need to save a bit more to get the benefits they want. The defined benefit scheme, so for example, within the local government scheme, the cost of actually the tax-free cash within the scheme is actually quite expensive. And you can see that if you compare the pension alone with the pension and cash, and most people take the cash, then obviously the overall projected value falls quite a lot. So that's one of the things actually then that we look at in terms of comparison on the tax-free cash. And also we also have a look at whether there's more tax-free cash actually available using the new route as well. And all of these factors would be explained in the staff presentation to make sure that members actually understood exactly what the impact was on them. And then finally we have a look at the contributions. And we say, okay, well, this is what you're paying at the moment, and this is what your net monthly cost is, and this is what the proposal looks like going forward, and this is what your net cost is on that basis. The final bit really then is, once you've got to that position, you really need to decide on the future scheme that you're providing. If it's a defined contribution scheme, then obviously in that scenario, rather than being in the big pooled pot of the local government scheme, contributions are paid into an individual pot for each member. So it's a bit like a pension bank account, which members can actually go in and take benefits. The eventual benefits from a defined contribution scheme aren't guaranteed. They depend on the level of investment return that you get and the cost of buying a pension at retirement, if you decide to buy a pension, because there are other options. So you can either buy the annuity or a pension income at retirement. You can take the pension annuity plus cash. You can take cash only with your funds, subject to paying tax on the balance over the 25%, or you can keep it invested in that pot, that bank account, and just draw the income off it as and when you actually need it. The defined contribution scheme, you'd actually sort of then be selecting, you can select different contribution bases. So you can just say the basis is we'll pay 10% and you pay 5%. Or you can do it and say, well, we'll pay the same amount as you, or we'll pay 2 times or 3 times what you're paying, which would be a matched or a multiple match sort of basis. You can look at different things like joining periods. You can look at different schemes for new joiners rather than existing joiners. You can have contributions tiered so that if you are there for a longer service period, you get a higher contribution rate. So all these things can actually be considered. And you can then compare the contributions obviously versus the existing contributions that members are making. Ultimately, the quality of the scheme you get in terms of pricing will depend on the contributions that are being paid in and the average contributions. You also need to identify if you're going to maintain the lump sum death benefits like in the local government scheme, and also any sort of critical illness cover, or if you want to provide some sort of menu of other sort of flexible benefits that people can pick from. So ultimately, in selecting the scheme, you want to get something that has good competitive charges, so as low as possible. As I say, that's based on the total contributions and the average contributions per member. You want an organisation that's financially strong, will be around in 5, 10, 15, 20 years to provide the benefits. Someone who provides a good range of investment options and good consistent returns, has quality administration, provides IT sort of web support so that members can go online and change their addresses and so on, and look at their projected benefits and whether they provide any other options at such as flexibilities on retirement, such as being able to do drawdown in your scheme or take partial amounts out of your scheme at retirement. So those would be the sort of criteria you'd need to look at for the scheme. Then in terms of sort of comparing for the member, I think these are the types of things that you'd be actually communicating and comparing for the members around the sort of transition. So looking at the impact of tax-free cash and how that might work with the existing scheme versus the new scheme, how the death and service benefits work, what would be the impact of early retirement and how you could actually use the two schemes integrated better, so actually the format of the sort of integration. So those sorts of things would be the types of things you'd want to actually be able to communicate for the staff. Okay, so just to conclude then, so in terms of sort of next steps, I think obviously you need to have some form of board agreement around sort of objectives and what you actually might want to do around the offer and how you're going to sort of consider the value of the offer and so on. Clearly, any organisation will have to manage conflicts of interest, particularly if sort of senior staff are participating in the scheme. It might be that the board have to take a much more active involvement in actually sort of managing this to sort of avoid those conflicts. I mentioned already sort of reviewing contracts and how those actually might need changed to actually allow this to happen. Then obviously you need to sort of put in place timing for staff consultation, and you then obviously, in terms of the timing around that, you need to have a project plan and have some contingencies in there if things don't go completely to plan, such as if members don't accept part of the transition or something like that. So some contingencies that allow the consultation period to be extended, for example. Then ultimately you need to leave time to communicate with the fund within their time period, and also to have a new scheme in place by the 1st of October for members. I think it's sort of the key to the summary with this offer is it is a completely unique offer. It's likely to be a one-off. In terms of unique offer, I haven't seen another fund in Scotland actually provide anything similar to this, so it's a very, very attractive offer, and Fife Council Pension Fund are I think very enlightened in terms of what they're looking at and how they're offering it. But as I say, it's likely to be a one-off, so if you miss your opportunity, then your exit debt effectively goes from that ongoing position to the cessation position, effectively from 30th of September to 1st of October. It obviously could have a very substantial positive impact for charities. I've seen the impact of charities being able to take it could improve their financial position by many hundreds of thousands of pounds, and some by in the millions. Obviously, you've got to recognise the impact on staff and try and smooth the transition as much as possible. But in my view, it's unlikely that unless there are very significant other factors, that accepting the offer is likely to be the preferred route for most charities who've actually been provided with it. So that pretty much concludes what I wanted to cover in terms of the sort of the slides. At this point, at this point, I'm happy to sort of review some of the questions.
There is one question there, David.
Yeah, okay, so I see that.
See it.
So we have a 6-figure surplus on an ongoing basis, but a 5-figure deficit on a gilt cessation basis. To contest the valuation, is there any chance of it? It's to date, my communications with Fife, they've been pretty sort of direct in terms of saying that the offer's the offer. If it's really a question of how the figures actually arose on that basis. Still being able to sort of cap off even at the sort of deficit level is probably still valuable, but it may be that there's some variation around the funding assumptions and how you've actually arrived at those that might be worth actually sort of negotiating around. So I think it's it's certainly something that is worth looking at in a bit of detail, such as for example, if you've built up surpluses as a result of sort of transferring in other benefits, for example, or there's been other sort of provisions made from the scheme in terms of how your benefits have actually accrued. I think it's worth looking at the actual detail of that to see if there's the potential to actually have a discussion with Fife around how they might calculate the benefits. Are there any other? There doesn't seem to be any other questions there. Okay, so obviously if there's anything specific, maybe you don't want to sort of confirm in terms of sort of the webinar. I'm happy to obviously just send me an email. Everyone's got my email sort of with the sort of invite and so on for this. What we'll be doing after the event is the event is going to be on the presentation is going to be on YouTube, so you can share it with other people in the organisation if you want. And we'll also send out copies of the slides. And as I say, happy to take any sort of specific questions around this from organisations post the event. So thanks very much for your time, and hopefully everybody found that of value. Thanks.